ECB keeps rates steady, rises Eurozone growth and inflation forecasts. Zelensky warns of 45 to 50 billion euros Ukraine aid shortfall, threatening drone production. And India rises foreign investment limit in insurance to 100% to boost coverage. Welcome to the Economic News Bulletin. We start off with Europe, where the European Central Bank, ECB, held interest rates steady and struck a more optimistic tone on the Eurozone economy, raising its growth and inflation forecasts. Recent data have beaten expectations, supported by resilient exports and domestic demand, while inflation is seen staying near the ECB's 2% target. The outlook suggests further rate cuts are unlikely in the near term, though the ECB said decisions would remain data dependent. Most economists expect rates to stay unchanged through 2026, despite some market speculation about a possible hike next year. European Central Bank President Christine Lagarde has signaled stability in the Eurozone monetary policy, keeping key interest rates unchanged while projecting inflation to remain near the ECB's 2% target through 2028. She also warned that geopolitical tensions, including Russian-Ukraine conflict and ongoing global trade volatility, could disrupt supply chains, weigh on consumption, and slow growth. Through planned infrastructure and defense spending may provide a boost.
The Governing Council today decided to keep the three key ECB interest rates unchanged. Our updated assessment reconfirms that inflation should stabilize at our 2% target in the medium term. The new Eurosystem staff projections show headline inflation averaging 2.1% in 25, 1.9% in 26, 1.8% in 28, 1.8% in 27, and 2% in 28. While trade tensions have eased, the still volatile international environment could disrupt supply chains, dampen exports, and weigh on consumption and investment. A deterioration in global financial market sentiment could lead to tighter financing conditions, greater risk aversion, and weaker growth. Geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, planned defense and infrastructure spending, together with productivity-enhancing reforms, may drive up growth by more than expected.
The Bank of England cut interest rates by 25 basis points to 3.75% after a narrow 5-4 vote, but signaled that the pace of further cuts may slow. Governor Andrew Bailey backed the reduction, saying rates remain on a gradual path downward, but future cuts are becoming a closer call as inflation risks persist. Some policymakers opposed the move, warning inflation, still the highest in the G7, could remain too high. Inflation fell sharply to 3.2% this week, while jobs data pointed to a weakening labour market. The bank now expects economic growth to stagnate in late 2025, reinforcing its cautious approach to further easing. Bank of England Governor Andrew Bailey has stated that British inflation could return near the 2% target by April or May 2026, about a year earlier than expected, after the central bank cut rates to 3.75%. Inflation fell to 3.2% in November from 3.6% in October. Bailey cited one-off factors fading and temporary measures in the finance minister's budget reasons for the expected decline. Interest rates remain influential, but further cuts may slow as rates approach neutrality. For further analysis on the ECB keeping rates unchanged and Christine Lagarde's statements, we are joined from London by political and economic advisor Babak Imamian. A very warm welcome, sir, to Qnews and the economic segment. Sir, how significant is the ECB's decision to keep interest rates steady, and what does it signal about the Eurozone's current economic conditions?
Thank you for your question. It is very difficult to understand how they arrived at their decision. For example, just let me take you back to what you mentioned about Bank of England, and then I would go back to ECB. Only a month ago, or 6 weeks ago, they were saying the inflation would come down to the level of 2% by 2027. Within a month, they say, no, actually a year earlier would come to that level, to that target level of 2%. So then you would ask, maybe next month they would change it and they would say with 2027 again. So what I'm trying to say, they come and make a statement, they give you lots of data, but it is all unreliable. And most of the predictions have been absolutely wrong. So whether Christine Lagarde, the president of ECB, would come and say, we are going, this is what is happening. Actually, today, what she said, she didn't say much. She just mentioned about the status of the economy.
Sir, she did not say much, but did she say facts?
She just went through the figures. She didn't actually say what is the cause of
What's
inflation.
your facts?
Well, first of all, she didn't, for example, I would have expected her to explain why it has taken so long for inflation to come down. And that's because of high cost of energy. And if you look at it, it's taken something like 3 years to maybe 4 and maybe 5 years yet for us to achieve that rapid jump in 2022 on the high cost of energy when it went up by 4 times. So we had that peak. And it's taken like 3, maybe 4, maybe 5 years for that to come down. Now, the prices doesn't come down. What happens is the rate of prices going up, the rate of inflation is coming down. And still, the European economy is suffering from high cost of energy, and there is no debate about that.
Sir, it's a point that's worth respect, of course, with inflation projected to remain near 2% through 2028. How confident can markets be that price stability is sustainable in the medium term?
Well, first of all, you talk about price stability. Nobody explains why this 2% inflation is good. Maybe it should be 1.8. Maybe it should be 2.2. Nobody has yet come up with an explanation why this magic figure of 2%. Nobody has done it. This has been the norm, the fashion, the culture since 1998. Previous to that, inflation was allowed to go between 1% to 4%. And central banks could then, they had much larger, bigger, the hands were much freer to act then rather now. Now, in order to achieve that sacred figure, 2%, which nobody knows why it came about and how it was deducted.
Do you want to say it's random, sir?
I would say it is, yes, illogical. Nobody has yet to
logical or random, because there's a difference.
They just picked up the figure Otherwise, if it was
Then
scientific,
it's
they would.
random.
Sorry?
Then it's random.
It is random because if it was scientific, it would be like 1.96 or it would be 2.14, something, not just 2%
Okay,
around
sir,
figure.
how do you interpret the ECB's slightly more optimistic growth outlook? Of course, this is against what you think, but it's a question. What factors are driving this positive revision?
Well, I would say a lot of it is politics. And that's a great question you are asking. If you just look at last month, OECD, the Organization for European Economic Development, Economic Cooperation and Development, they were predicting that the Eurozone or the European economy overall would grow by 1%. And Lagarde said today it would grow, actually it's 1.2, it would go to 1.4, and the British economy was doing 1.2, and they were talking about these range of figures. And they know they are in trouble in Europe in many ways: high taxes, high regulation, high energy costs, green policies. They have so many problems. But then the prediction for US was 1.7%. So and it doesn't make sense. Here in US, they have the cost of energy is a quarter of what it is in Europe. The regulations are much less. The business environment is much better. There is about 21 trillion of investment coming into US, and you have a proactive president that constantly, he doesn't go for trade agreements. He goes for trade contracts, which is much different.
Are you referring to US President Donald Trump?
Sorry? Yes, I'm referring to President Donald Trump. So I mean, according to OECD, OECD, the only difference between European performance and US performance is 0.5%. Now, that doesn't make sense. That the growth, all that effort that President Trump is doing, and I go back to 21 trillion dollar of investment coming into US, while maybe less than 2 trillion coming entire Europe, and yet they are saying the growth is only, the difference is only 0.5%. It just doesn't make sense. So when you say how these figures they arrive, I think a lot of it must be political.
Sir, to what extent could geopolitical tensions, especially the Russia-Ukraine conflict, derail the ECB's growth and inflation forecasts, of course, in light of the political side that I don't want to discuss now because we're discussing economics merely now. In light, of course, of what's happening and all the calculations that are going wrong now as we talk.
Well, Lagarde Christian Lagarde talk about financial stability and said the European banks are very stable and they pass all the stress tests. And yet only today, if the European politician go ahead with actually utilizing the frozen assets of Russia and confiscating that, yes, that would derail the entire trust in European banking system. So whether, for example, in that case, if you're Indian or Pakistanis, you say, if we have a conflict, are our assets going to be now confiscated? If we are Thailand and Cambodia, because we have a border dispute, are assets going to be confiscated? Or even US, if US has an issue with Venezuela, are the Europeans going to confiscate US assets in Europe? The whole idea of confiscating frozen asset of Russia, there is no logic behind it. And the people who are making decisions, they have no understanding of geopolitics, of international trade and international banking, and they are destroying the entire trust, the trust in European banking. So when you say, I said this was a major issue here.
how might global trade volatility and potential supply chain disruptions affect Eurozone businesses and customers in the near term, sir?
Well, thank you again for a great question.
You're welcome, sir.
Pleasure. And you see, trade agreements, there is this misconception that trade agreements means trade. No, it doesn't mean trade. For that, you need business people, you need manufacturers, you need people who have something to sell, to go to other countries and sell. So if you have a trade agreements, but you don't have anything to supply, then what is the point of having a trade agreement? There is nothing. So you actually need people who go and get contracts. So getting contracts, trade contracts, is a lot. That's the key. That's where the money is, not trade agreements. But a lot of politicians use obtaining trade agreements as fantastic. We've done our job. No, that's not. The problem is the European private sector is much smaller than American private sector. And these are the people who will go and get the contracts, sell European goods, create trades. But because in Europe, we have much smaller private sector, and the private sectors are taxed high. They are highly regulated. There is little support for them. So when it comes to international trade, they fall behind.
Sir, what impact could planned infrastructure and defense spending have on growth, and is it enough to offset other economic risks?
Well, right now, the biggest economic risk we have is this idea of AI efficiency, because they had told us in 2008 that we would have driverless cars. We would have driverless lorries. We don't need any more lorry drivers. And by 2019, there was a shortage of lorry drivers because the promises that were made in 2008 about the technology of AI coming, automation is coming, and all these jobs like drivers would be redundant, it came out not to be true. In 2014, they were predicting, but by now, by 2025, there will be no internal combustion engine. There would be no petrol cars anymore. And that has turned out to be a bad prediction. So right now, all the efficiency that they're promising with AI, like you don't need teachers, you don't need engineers, you don't need doctors anymore, it's come out to be wrong. So right now, the only thing is left for them is to increase the military spending to compensate for all the mistakes that they made and the lack of investment for key workers like people in field of medicine, people in field of engineering, people in commerce, people in field of transportation, people in field of education. You just go through it. Now, they want to actually compensate the training by increasing the military spending and getting the domestic consumption high again.
From London, that was political and economic advisor Babak Imamian. I can't thank you enough for your intellectual, of course, and informative knowledge and insights, and for your time on top of all. Thank you very much for joining us. And back to our news, and still in Europe, Manchester City reported £694.1 million in revenue for 2024-25, the third highest in its history, despite a £9.9 million loss and no trophies. The club's diversifies income streams, including commercial deals, match day earnings, and broadcasting, helped maintain stability. Off the pitch, progress continued on the £300 million North Stand, an entertainment destination, a £10 million women's performance centre, and an hotel partnership with Radisson. Social media reach hit 13.9 billion video views, boosting commercial potential. Ukrainian President Vladimir Zelensky has warned that Ukraine could face a 45-50 billion euro foreign aid shortfall in 2026, threatening its drone production. Speaking in Brussels, he said without a first tranche of a loan secured by frozen Russian assets by next spring, Kiev would have far fewer drones than Russia. Zelensky said Ukraine is open to any mechanism to access the assets, but prefers the current loan plan, which they discussed with Belgian Prime Minister Bart de Wever. De Wever opposes the proposal, citing legal and political risks, as Belgium holds 185 billion euros of EU's 210 billion euros and frozen Russian assets. Polish Prime Minister Donald Tusk said EU leaders agreed to explore using the frozen assets to finance Ukraine in 2026-2027 instead of joint EU borrowing.
України буде зменшено в рази виробництво дронів.
Moving on to Asia, India's parliament approved raising foreign investment in the insurance sector to 100%, 74%, aiming to boost coverage and attract global insurance penetration stood at 3.8% of gross domestic product in 2024. The Sabak Sabika Amendment of Insurance Laws Act of 2025 also allows mergers with non-insurance firms and powers to regulate, to set agent commission limits and recover wrongful gains while dropping a previously proposed unified insurance license. U.S. consumer prices rose less than expected in the year to November, but economists said the easing was likely temporary and affordability pressures persist. The consumer price index increased 2.7% year on year, below forecasts of 3.1%, while core inflation slowed to 2.6%. The figures were clouded by a government shutdown that halted October data collection, with economists noting that weaker reading may reflect holiday discounting and could reverse in December. Tariffs have continued to lift prices, with about 40% of their cost passed on to consumers so far, hitting lower income households hardest. The Labor Department has reported that new U.S. unemployment claims dropped 13,000 to 224,000 for the week ended December 13th, suggesting a stable labor market. The recent fluctuations reflected seasonal adjustments around Thanksgiving rather than a major shift in hiring. Continuing claims rose to 1.897 million, indicating longer spells of unemployment for some workers. Businesses remain cautious about hiring, citing tariffs as a top concern, according to a recent survey of chief financial officials. The United States Senate overwhelmingly has approved a $901 billion bill outlining Pentagon policy and sent it to the White House, where U.S. President Donald Trump is expected to sign it into law. The legislation authorizes a record annual defense budget of $901 billion, includes a 4% pay raise for military personnel, and introduces reforms to the military procurement system. It also makes a priority to strengthen U.S. competitiveness against China and Russia.
the 65th consecutive year that Congress has come together across the aisle and across two chambers to send the President a bill designed to sustain and strengthen.
Yes, President Donald Trump has pledged sweeping reforms in the housing and healthcare sectors this year to reduce costs for Americans. In a speech highlighting his administration's achievements in seeking to ease growing concerns over living expenses, Trump said housing-related reforms would be unveiled by year's end. He also criticized former President Joe Biden administration, blaming it for its pro-immigration policies for driving up property prices and rents across the United States.
And I'm fixing it. 1 year ago, our country was dead. We were absolutely dead. Our country was ready to fail, totally failed. Now, we're the hottest country anywhere. 11 months ago, I inherited a mess, and I'm fixing it. 1 year ago, our country was dead. We were absolutely dead. Our country was ready to fail.
CEO Carsten Spohr has announced that Lufthansa plans to expand U.S. flights and promoted new premium seats Algiers to boost transatlantic growth. The airline has shifted its bookings with nearly 60% now from the U.S. and is increasing flights from smaller cities like Dorma and St. Louis. New wide-body jet deliveries next year will further expand capacity and help overcome past delays from Boeing and Airbus that hurt profits and share price.
Forward bookings for 26 are strong, and at the same time we've been able to
In the energy sector, U.S. President Donald Trump is moving into fusion energy through a $6 billion stock merger of his social media company, Trump Media, and Google-backed TAE Technologies. The deal follows industry calls for increased federal funding for fusion research. Trump Media CEO and TAE CEO will serve as co-CEOs. The media firm, mainly earning from Truth Social advertising, posted a $54.8 million loss in the third quarter. The merger expands Trump's business portfolio into clean energy alongside ventures in cryptocurrency, real estate, and mobile services.
Seemingly going well, but we've been saying that for a while. Amazing, and they have been amazing, having to do with Russia and Ukraine.
The European Union sanctions 41 additional ships in Russia's shadow fleet, bringing the total to nearly 600. These vessels are banned from EU port and deprived of various maritime services. Despite 19 sanction packages, Russia continues selling oil to India and China at discounted rates, using shadow fleets operating outside Western oversight. Earlier, the EU targeted oil traders Mortaz and Itbar EU for helping Moscow bypass sanctions funding the war in Ukraine. The new Czech government is exploring options to acquire utility company CEZ, potentially one of the country's largest energy shake-ups. Prime Minister Andrej Babis has pushed for full control to strengthen energy security. Industry Minister said options include taking over 100% of CEZ's generation assets while leaving distribution trading assets public, or acquiring the entire company and later relisting parts. The process could take up to 2 years. The buyout could exceed 200 billion crowns, drawing criticism over cost, lost dividends and potential debt. He also noted that CEZ's strong earnings of 130 to 140 billion crowns before interest, tax, depreciation and amortization say the company could handle the acquisition without jeopardizing investment.
Prostřednictvím vlastního výkupu akcí společnosti ČEZ 100% kontrolu nad výrobou.
That brings us to the end of our economic bulletin. Here's what we have been covering. ECB keeps rates steady, raises Eurozone growth and inflation forecasts. Zelensky warns of 45 to 50 billion euro Ukraine aid shortfall, threatening drone production. And India raises foreign investment limit in insurance to 100% to boost coverage. This concludes our economic bulletin. Don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at QNewsEG to stay informed. Thank you very much for watching. Thank you very much for our team who worked very hard on this program. And stay tuned for more updates on Qnews. I'm Rana Qasas. Goodbye.